everyone to today's session of How to Manage Finances During Cancer, Financial and Tax Year-End FAQs, led by Rick Bingerman. This program is hosted by the Blum Resource Center. Over at the Blum, we are grateful to Rick for this continued partnership. The recording of this session will be posted on our Blum YouTube playlist and our Blum Digital Resource Center. For those of you watching live, if you have any questions related to today's program, please feel free to utilize the chat feature throughout the session. At the end of the session, your questions in the chat will be used to moderate a Q&A. If you have any other questions or would like more information about resources and programs offered through the Blum, please visit our website, www.dana-farber.org/resource center, or email us at blum_center@dfci.harvard.edu. Thank you all for joining us. I will now pass the workshop over to Rick.
Thanks, Sierra. So this is a series of webinars that we do. The topic is how to manage finances during cancer treatment. And I'm going to just kind of walk through these slides. If I can move these forward. There we go. And this is financial and tax year-end FAQs. These are just questions that we received. Some of these might apply to you, some might not. Maybe you know somebody that might apply to, so you can feel free to pass that on if you think it could help somebody else as well. Just a little bit about who I am. I'm the guy in the middle holding that little trophy. This was back in 2011. So we had, won an award of $5,000 towards this program, which got donated to the Patient Assistance Fund. And that's a fund that has money that's set aside directly to patients in need. So if that's something that you're interested in, you could talk to your social worker about that. And just a quick disclaimer, this is just really broad-based education. It's not meant to be legal or tax or financial advice in any way. If you have any specific questions, the last slide has my contact info. So you can either type a question into the chat box, or you can email me afterwards and see if I can help you with something specific. So the one question is there anything that I could be doing before year end to save on taxes? So 12/31 is coming up fast. Today we're sitting here on the 14th. This was done several weeks ago, so there's a little less time, but there's still time to do a few things that might be able to help lower your taxes for 2023. So yeah, I'm saying there are still a few things that we can do. So IRAs come to mind because when you put money in a deductible IRA, you can deduct that from your taxes, and anything you deduct on your taxes can lower your income and therefore lower your tax liability. So if you're eligible, you can actually contribute to a deductible IRA. You have to have earned income, so you have to have some kind of job where you're working, or alimony actually counts if you're receiving alimony. That can count towards income. Now, you may not qualify if you or your spouse has a plan at work. A little convoluted, but if you have a plan available at work and you are single and you make more than $73,000 in 2023, then you can't do a full deduction into an IRA. If you're married, the number jumps up to $116,000 for 2023. So you can't do that. But if your numbers are below that and you have a plan at work, you can still do a deductible IRA. Now, if you don't have a plan at work available to you, there's no limit whether you file single or you file married. You can make as much as you want. There's not a problem. You can still do the full amount of $6,500 if you're under age 50, and if you're over 50, you can do $7,500. Those numbers are going up, by the way, in 2024. So they generally do increase every year. As far as those limits on how much you can earn if you have a job with a plan or you don't, those go up each year as well. Now, if your spouse works, it gets a little more convoluted. If your spouse works, has a plan at work, like a 401k or 403b, and your combined income is above $218,000 for 2023, then you can't do a full contribution into an IRA. So there are some rules around it. But one thing that's a little unique about IRAs, unlike a lot of other planning things we could talk about, is that have this December 31st deadline, is you can actually make a contribution into your IRA for 2023, and you have all the way up until April 15th of 24 to do that. So it buys you a little bit of time if you don't have the money available to actually make that contribution, but you can still deduct it in the 2023 tax year. So workplace retirement plans, if you have a job somewhere and there's a 401k or 403b or 457 available, and you haven't maxed out your contributions, then you could potentially add more before year end if you're able to do that from your remaining paychecks. And that's another way that you can reduce your taxable income. Your employer has to allow for a change in your contributions. Some employers are very flexible. Other ones really don't have that in place. They can't do that. And only pre-tax contributions will reduce your income. So we talked about making a deductible IRA contribution. There are also things called Roth IRAs where you don't get a deduction today because you're putting in money that you've already paid taxes on. The money grows tax-free in a Roth. And when it comes out, under certain guidelines, it comes out tax-free. And 401k plans, 403bs, plans like that at work. Now, some of them have provisions where you can do a Roth contribution. So if you're putting money in your 401k or 403b at work and you're putting it in the Roth bucket, then that does not lower your income today. It still might not be a bad idea, but it won't lower your taxable income. So that's something to bear in mind. Tax losses. So here's another thing that you can do. You've got up until December 31st to do this. I recommend doing it sooner than later because these custodians, wherever your investment accounts live, get very busy at the end of the year. So you really want to do it ASAP. But if you have a non-retirement account, so we're talking not an IRA, not a Roth IRA, nothing like that, just an investment account could be held at some type of custodian. And here's an example. Let's say you bought ABC stock in April of 22 for $10,000. And today it's worth $2,000. That doesn't feel good because you actually lost on paper $8,000. You have an $8,000 loss. Now you could realize that loss by selling that stock, that ABC stock, and realize the $8,000 loss. And you can use that towards your tax liability. If you're working, you can take the first $3,000 and offset ordinary income from that. And the remaining could be used either to offset capital gains, or it can be used for future years. You can carry that forward to future years and use it as $3,000 a year until it's used up type of thing. There's a little link here too you can click on that explains a little bit more how this works, but it can be a good way if you've got a loss, an investment loss. So one thing that does come up though is, well, can I buy that back? If I like company ABC stock, you can buy it back after you take the loss, but you've got to wait at least 30 days to do that. There's something called a wash sale rule. And if you buy it back before then you cannot take that deduction. So there are some tricks there. Also, if you sell it in one type of account and you want to buy it within 30 days in another type of account, even if it's a different account, that's not allowed either. That kind of runs afoul of that wash sale rule. So you just got to be careful with that. You got to wait at least 30 days to buy that security back. Okay, flexible spending accounts. So some of you might be contributing to these right now. This is where you take money from your paycheck and you put into this flexible spending account. And this money can be used to buy health-related expenses. Could be anything from prescription eyeglasses to medications to over-the-counter stuff, Band-Aids, masks, COVID tests, all types of different things you can use it for. Usually these accounts have to be emptied out by 12/31, or it's kind of a use it or lose it thing. So if you do have money in an FSA or a flexible spending account, you want to make sure by 12/31 that you empty that account and buy stuff with that money. If there's still time to put money in, some employees allow you to do that. You could put money into an FSA before year end. There's something called a qualifying life event that they could allow you to. For example, if you're in treatment and you're not working, or you're helping a loved one as on family leave, or just helping them, or there's a death of a spouse, there's some rules that allows you to put money in the FSA. But again, you got to take it out by 12/31, so not a whole lot of time. But it does lower your taxable income, so that can help you with your taxes. And again, there's another link here if you want to click on that at some point, and you can read more about how those work. Qualified charitable distributions, that's something that's a little more complex. That's if somebody has an IRA with money in it and you're over 70 and a half, you can actually make a donation to a charity or a nonprofit and receive a tax deduction. So It's called a QCD, a Qualified Charitable Distribution. You don't have to be taking required distributions, which those kick in anywhere depending on when you were born at 70.5, at 72 or 73. And if you're born after 1960, it doesn't kick until 75. You don't have to take a required distribution to satisfy your retirement minimum distribution, but you can always, over 70.5, give money to a charity. You got to be charitably inclined because the money goes to a charity, but it is a way to reduce your income. And again, you can click on that link if you want to learn more about those. Zipping through this today. Donor advised fund. These are kind of cool. This is also known as DAF. There's a lot of initials in the whole financial world. A donor advised fund lets you donate money, again, into this donor advised fund. And then from there, it can go to different types of charities or nonprofits. The difference is when you make a gift to a charity directly, it goes there that year and the gift is done. In a donor advised fund, the money goes into the donor advised fund and it can sit there for decades and it can be invested and can be growing in different types of investments. Or you could give it out every year, or you could wait 5 years and start then. It's very flexible, but you get the deduction in the year that you put it into the donor advised fund. So let's say, for an example, Mary gets a big, bonus at work and she gets $50,000. Well, that's going to increase her taxable income most likely. It might even push her into a higher tax bracket. She can make a gift to a donor advised fund with that money. Again, it goes to a charity or a nonprofit at some point, either right away that year or down the road, but she gets that tax deduction up front. Now, this last bullet point that says maybe best to use appreciated assets versus cash. Generally, when you make a donation to a charity, you just write a check, use your credit card, and that's considered kind of cash. But an appreciated asset would be an investment that you own that's grown in value. So we had that example, earlier, that the person had an $8,000 loss. They bought stock for $10,000. It dropped to $2,000. They had an $8,000 loss. Well, instead, they could have invested $10,000, and years later, it could be worth $100,000. Now, if they sold it then, they'd have something called a capital gain instead of a capital loss. And that capital gain is reported as taxable income, so it could increase your taxes. Well, you could instead take that $100,000 of stock, put that into this donor advised fund, and the charity, because they're a nonprofit, doesn't have to pay taxes on that. So it's a better way usually, but again, you want to check with your tax preparer, your CPA, on which gifts make the most sense to donate. And again, there's a little tab there that you can click on a little. And the last piece is financial planning. So my firm, we're a financial planning firm. We help people with investments, financial planning, college planning, taxes, all that stuff. But we always start at that financial planning piece because it's really key to know on just upfront, like what's coming in versus what's going out. So it's always good going into the new year. It's a good time of year to do this, to see what your expenses are going to be going into the new year, what your income is going to be going to the new year, and put a plan together to make sure that hopefully more is coming in than going out. And if more is going out, to look at ways to maybe reduce what's going out. So we look at fixed expenses, we look at variable expenses. A fixed expense are fixed. They're like things like your rent or your mortgage, your car payment, things that you don't have a whole lot of control over, pretty much the same. Going to Starbucks, going out to dinner, those are variable expenses. And we can control that a little bit because we can try to minimize that or look for other things. On the fixed side, though, there could be ways to save money. You might want to look at what you're paying for car insurance or home insurance. There might be some ways to reduce those costs, things like that. So again, every year it's good to look at this. If you have a workplace plan, again, like a 401k or 403b, you want to try, if you can, to contribute at least as much to get that company match, because some companies will match contributions that you put in, and it's like free money. So ideally, you want to try to put in at least enough to get that free money, that match. And the last piece is this estate planning piece. Some people think, oh, estate planning is for rich people. It doesn't really apply to me. But estate planning is really for everyone. And estate planning is really just making sure that your wishes are carried out if you become disabled, can't work, or you pass away. So they can include things like a will, things like a durable power of attorney. That's a document that allows people, one or more people, to have control over your financial life. They can do things like pay your bills or refinance your mortgage or sell your house. It's very broad based, but you can limit what someone gets to do. There's things called healthcare proxies, which at Dana-Farber, you might have filled one of those out. That's so someone can make some health decisions for you if you're unable. There's things like a living will. That's really more of an end of life thing, of life support, what your wishes are there. And then there's trusts, and trusts are a little more complicated, but they allow you to have a little bit more control, especially if you've got younger kids and you pass away. You might not want, a 14-year-old to inherit a lot of money. A trust can put some stipulations on that. And if you are a patient of Dana-Farber or a family member, we have, through the pro bono financial coaching program that I mentioned early on, we have estate planning attorneys that for either little or no cost will put these estate plans together for you. So if that's something you're interested in, on the last slide's my info, feel free to reach out to me or reach out to your social worker, let them know you want to be part of the, pro bono financial coaching program. It's a mouthful. And then there's an old video here that we did that kind of walks through like all this kind of stuff if you want to check that one out as well. I think that might be it. Yep. And then my offer to you, it's holiday time for giving. Happy to talk to you. Ideally, you can call me, but email is best because then I can make sure I get it because I'm in meetings, I'm on the phone a lot. So just feel free to reach out to me with any questions you have, and we are here to help. And it looks like there might be some questions that came in.
I can read them off if that works for
Sure.
you. So one of the questions is, my son is 17. Can he contribute to a deductible IRA?
If he has earned income, he can definitely, we actually have a kid who's just turned 6, and we're gonna do an IRA. Did a commercials and made, I think, $4,000. So again, the most you can put in is $6,500 if you're under 50. It's going up next year, but you can put in as little as you can, or the maximum is that $6,500. But as long as they have earned income from some type of work, then there's no age limit. And there's no age limit on the other side too. If you're 80 years old and you're working at wherever, Trader Joe's, and you're making money, you can actually put money in an IRA as well. Not a problem. The Roth IRA, the same rules apply for the age. It's not a problem. It's just that one is deductible and one isn't. The Roth is not deductible, but it goes tax-free. In the case of our 6-year-old or 5-year-old, whatever she is, I'm recommending a Roth IRA because she's got a long time. She doesn't really need the deduction because she doesn't really have any other income. So we're going to put in a Roth IRA and just let that thing grow for the next 50 years or so until she retires.
Got it. Thank you. And I think that
Sure.
answers one of the other questions that we had in the chat. I do have one more. The question is, can I contribute to an IRA once I've retired, which I think ties into the earned income. So maybe not.
Right. Now, if you have a spouse that's working and you're married, you can actually do a Roth or a regular IRA for each of you, or one of you, doesn't matter, called a spousal IRA. So even if you have no earned income and you're married, that's a good point, you can actually still do a Roth or a regular IRA. Whether it's deductible depends on those limits, whether there's a plan at work or not, but you can, yeah, you can.
Awesome.
Yep.
Great. Well, thank you so much, Rick. I don't think we have any other questions at this time. We really appreciate you coming on, Rick, and giving us
Happy to
that
be
great
here.
program on financial and tax year-end FAQs. Thank you all for logging on and watching this live. If you're watching this on YouTube, please be sure to check out some of our other finance programs as well. We have many other resources on our Digital Resource Center, which can be found at www.dana-farber.org/resource center. And thank you all for joining us today.